Good morning, it's Jeffrey Christian. It's 9:20 on Friday, the 5th of August here in New York. We're going to be talking about a whole lot of things. You can see from my cover, a raft of topics that I want to cover. So I'm going to try to cover them and talk fast. We thought about spreading them out over several weeks, but they're all things that people really ought to know about now. A lot of them actually have come from either questions or comments that people have made to our reports or our videos. And, frankly, a lot of those comments, we just, we read them, we like them, we laugh at them, we ignore them. But some of them, I think, actually either warrant a response or trigger us to say, hey, this is something that people are asking about or commenting about, and we should address those issues and help them. So you can see, there's a question, well, I term here an irrational what if comment that we had, question that we had, and I used that to build off of that and talk about some of the realities of investment buying values and volumes. And I'll just tell you right here, the important thing to understand is that most investors don't say, I want to buy X ounces of gold or silver. They say, I want to put X dollars or kwaches or euros or whatever their currency is. I want to put X value into precious metals. And that's important when you look at how much precious metals are being purchased. And I'll show you some data from our gold yearbook and our silver yearbook that explains that. So just so you know what's coming up. I also want to talk about the commercials. There's a lot of bad information floating around about the fact that commercials, as defined by the CFTC, have gone long silver and platinum and palladium futures. And there are people waving their arms saying, oh my God, the banks, they know what's going on. They're loading up before the prices explode. That's not at all what's happening. I'll explain that. There was a alleged $50 million silver coin purchase by a single investor who clearly got ripped off by her salespeople. They were not advising her on a fiduciary basis. They were advising her on a basis of how much can we skin this person alive and keep her going so that she comes back and buys more. And then there's some other questions and challenges. One of the things that I don't have on the list that we hear about is, are we in a recession? And my first response is, we had 2 quarters of negative growth, and that is roughly the definition of a recession. I will leave it to the National Bureau of Economic Research Committee to decide whether or not that's a recession. But if you're asking me that question, that's the wrong question. And if you're asking me that question, you're off the mark. The important question is what's going on in the economy right now. We have had a very weak housing market. We've seen sharp declines in the housing industry because the prices have gotten too high and mortgages started rising. We've seen manufacturers and businesses reduce their inventories, partly because they can't get the stuff because of supply interruptions, and partly because they look down the road, they've seen the guys in bow ties waving their arms saying that we're going into a recession, and they're cutting back on their inventories against lower sales. And they have seen lower sales in some applications, partly because of lower prices. I mean, who buys beef these days? Don't answer that. So the important thing is not whether or not we're in a recession. The important thing is where are we in the economy? What are the conditions? There are pockets of strength. We saw the employment figures come out today much stronger than the market consensus. I've made the comment before, I don't put big weighting on markets consensus, but the markets do. So gold fell $20 in response. But we're in a place of lower growth, which had been expected. Possibly we were in a recession in the first half of this year. Possibly we're still in a recession now. We have to see how things are going. But look at where we are in terms of the economy and demand from consumers, business equipment purchases, construction, fiscal stimuli, which has been pulled back a lot, but probably is going to accelerate next year and help keep us going for a little bit longer, and a variety of other issues. The markets for gold, silver, platinum, palladium this week reflected that transition. We saw prices fall very sharply into the middle of July. They came back, but they haven't come back too strongly. Gold has struggled to be over 1800. It got up to 1805 a couple days ago. It got up to about 1811 this morning. But after the employment figures came out, people said, okay, stronger economy, stronger interest rates, lower inflation. I think I'm going to sell off some gold. Silver, similarly, silver's been even weaker, and we'll get into that in a little bit longer. Our expectations have been, as we've said in previous videos, that the prices will probably stay weak during August, and then we'll start seeing some modest increases in the final 4 months of this year. That's our expectation, subject to changes in the economic and political environment. So that's sort of where we're going to go. Let's see where we go. Oh, cute little quote from Anton Chekhov. Wisdom comes not from age, but from education and learning, and also being able to understand what you're reading. Now, the first comment was Quant 2011, cute name, said, hey, Mr. Wig, okay, we know where he's coming from. What if 666 billionaires all want to buy 1 million ounces of silver at the same time that 10 million millionaires want to buy 1,000 ounces? Wouldn't that drive the price higher? Yes, it would, for at least a nanosecond. But that is what we call adductio ad absurdum. You take an issue to its wildest extreme. And we'll talk about interest rate expectations later, because there was a comment about that too. That doesn't happen. It's an irrational view. This guy is starving to find a reason to believe that silver is going to $100 or $1,000. And he comes to this absurd extreme that has never happened in mankind, probably will never happen in mankind. But hey, what if? Okay, this justifies the fact that I've been long and wrong for all that time. One of the things you have to pay attention to, going back to what I said at the beginning, investors buy less metal for the same price as the prices rise. Partly because their price sensitivity. Hey, when gold was 2050 in 2018, I was a big buyer. When gold got to 2,100 in early 2022, I wasn't such a big buyer. When gold got to the 1,800, I wasn't a big buyer. When it spiked down to 1,680 in the middle of July, I bought some. When it spiked right back up, I'm waiting. So what you see is price sensitivity. The second thing is that, as I said earlier, investors say, I want to put a percentage of my wealth or a percentage of my portfolio or a certain amount of money into gold and silver. They don't say, I want to buy 7,892 ounces of silver, right? So that, as the price goes higher, makes a big difference. Now take a look at these. These are from our gold yearbook and our silver yearbook. This is global private financial wealth. And it's, if you can't see, I have to put my glasses on. It's trillions of US dollars. We started collecting, we have the data for gold and silver going way back, but the data for equity securities on a global basis, private debt holdings, government debt we have, loans, that data was sparse to come by. There are some groups that have come up with some data since 1980, which allows us to say, here's a portfolio of private sector wealth. And it was, you can see, $50 trillion in 1990, up from about $10 trillion in 1980. And now it's over $360 trillion. And gold, as a percentage of it, is this little bitty red sliver at the top. Right? And here's the key. You can see gold as a share of private wealth. It got down to 68 and 80 are CPM Group's estimates. We think that gold was much more important in 1968 and 1980. before gold dollar standard ended and the spigots of paper assets opened up. And you've seen about a 12% per annum compounded annual growth rate since 1980 in paper financial assets. And gold has not competed with that. You got down to about 0.2% by the year 2000. Gold entered a bull market and we got up to about 0.85%. Less than 1% of the world's wealth, by private financial wealth, was in gold at the peak of the market in 2011, 2012. And most of that enormous increase reflected the increase in the price of gold and thus the increase in the value of gold holdings that were already held in the year 2000. Some of the increase reflected new additions of gold being bought by investors and added to their holdings. But the vast majority of the increase in gold's role in financial portfolio was not people buying gold, just the value rising. So there were people who were smart enough to own gold in the year 2000. And when the price of gold rose, they said, well, do I need to buy more gold to maintain that percentage of my portfolio or my wealth or my expenditures that I want to have in gold? And they say, oh, wait, the price has risen. I don't need to. Yeah. Then you got into the bear market until 2015, 2016. You kind of bounced around and it's risen back up a little bit. But the key is that as the price rises, investors buy less gold and silver with the same amount of money. Now this looks a lot more bullish because we have a scale that only goes to 0.07%, which is much lower than gold, even at its bottom. But you can see the same sort of thing. And the point is that investors invest in precious metals, and stackers buy precious metals based on the dollar value. So let's just run through some numbers. In 2018, the gold price averaged $1,270. If an investor said, let me put $10 million into gold, that investor would have bought 7,873 ounces. By 2021, the gold price had risen 42%, and it was at $1,800 an ounce on average in 2021. And that same investor saying, I want to put $10 million into gold, would have bought 5,500 ounces. And this year, in the first half, the price of gold is up another 4% in the first half compared to last year, full year last year. He would have bought even less gold, or she, right? So to go back to Quant's question, if investors, a lot of wealthy investors, decided all at once to start buying metal, they would drive the price up for a period of time, which is what we saw in 1980 and 1988 and 2008, 2011. And then the price would come down because they wouldn't buy that much metal. You can say, yeah, but if they did, the price would go up. But that's like saying, if we all had to live off of watermelons, the diets would really be quite different. It just is a reductio ad absurdum. It's a nonsense question that people ask when they have problems. When commercials go long, what's it mean? Okay, commercials go long. This is another topic we've explained a lot, but obviously we have to explain it again. In silver and in platinum and in palladium, investors have shown a tremendous amount of disenchantment. Short-term investors who invest in futures and options. They are now net short silver, they're net short platinum, and they're net short palladium. There are people out there who will tell you that there's a bank or two banks or three banks and Jeff Christian who control all this stuff, but that's nonsense. Commercials, you have to understand who commercials are. You also have to understand how futures and options work. When someone wants to buy a futures contract or an options contract, someone has to sell that to them. That contract is created when one person says, I want to buy, and the other person says, I want to sell. The prime movers across commodities, almost universally, especially in gold and silver, platinum, and palladium, are the investors. The investors go to a commercial and say, I can't find any other investor who wants to sell me a future. So you're a market maker. I want to buy a future from you. And that market maker then sells, goes short. That's how the market normally works. And you can see here, this is silver, non-commercials on the left-hand side, commercials on the right-hand side. Non-commercials have been positive net long for most of the period since 1996 when the CFTC revised and modernized and improved its data, so the data prior to 1996 is not readily comparable. And the commercials were net short. They were net short because they were trying to suppress the price. They weren't net short because of any other nefarious reason. They were net short because they are there to sell futures and options when investors want to buy them. Now we're in this awkward situation, similar to what we saw for a time in 2018, 2019 at the low in silver prices, where investors want to be net short. And if investors want to be net short, the commercials by definition have to be net long. It's not that they've seen the writing on the wall. It's not that they know that the grand conspiracy that suppressed silver prices for 60 years is ending. It's not that they know that the silver price is going to explode to the upside. It's that their customers don't want to buy futures from them. They want to sell. The customers, the investors want to go short, and the commercials are market makers. If someone wants to buy, I sell it to them. If somebody wants to sell, I buy it from them. It's a mechanical reflection of weak investment demand in the futures and options market from investors for silver. Nothing more, nothing less. Hate to disappoint people, but hey, I'm here to disappoint. No, I'm here to help people make money. And you're not going to make money if you're playing gold and silver based on a bunch of myths that aren't accurate. It's happening in platinum too. We're now net short. Again, you can see usually investors are net long silver or platinum. They have gone net short a couple times. They did go net short back in the 90s for an extended period of time. Well, they were bouncing back and forth. They are now net short again. And ergo, ipso facto, the commercials are net long. And it's happening in palladium too. They're net short. It's not happening in gold. We have seen a massive decline in the gross and net long positions of futures and options in gold on the part of investors, but they're still net positive about 10 million ounces. So the commercials, I don't have the chart for the commercials, are still net short gold. Not because they're suppressing the price, because their clients want to buy. Now, a $50 million silver coin ripoff. Back in the 1980s, we were working with a very nice lady who was a centimillionaire, and she wanted to put $50 million into silver. And a coin dealer caught wind of this and convinced her that she should buy Eagles. This was about 3 years into the Eagle and Maple Leaf silver coin programs, and silver was about $6 an ounce. So she would have wound up buying like 7 or 8 million ounces of silver, which would have been about a third of the silver bullion coins that were in existence at the time. So we sat down and we said, why would you want to have coins? And she said, well, I might need them to buy, groceries and stuff. Centimillionaire. A really nice person. She is, by the way, now a billionaire, or her family is a billionaire. I'm not sure if she's still around. I think she is. We convinced her, okay, buy a couple thousand ounces of silver coins. They're beautiful coins, and buy a couple thousand ounces. But for most of those ounces, what you want to do is buy 1,000-ounce bars that are good delivery, that are in registered, recognized, reputable depositories. And that way, when you want to sell them, you don't have to worry about somebody saying, is this legitimate silver? Or is this tantalum plated with silver, et cetera, et cetera. There's no assaying or anything. If you don't move the stuff from a recognized third-party depository, where it's been in their custody physically, you don't have those kinds of charges. And she did. She made a lot of money. Like I said, she's a billionaire. Now there's a story that some multi-billionaire lady in Texas went to some less than reputable people and said, I want to buy 50 million ounces of silver, $50 million worth of silver. And they said, buy coins. If they were reputable and said, well, buy a couple thousand ounces of coins and put the rest in 1,000-ounce bars. 1,000-ounce bars yesterday were $21.58 an ounce, right? She could have bought 2.3 million ounces of 1,000-ounce bars, silver. Eagles were $32.59, hefty premium there. She would have only gotten 1.5 million ounces of silver Eagles yesterday for $10 million. She would have paid a premium of $11.01, which is 51% of the price of silver yesterday. She would have paid a third of her wealth, of her investment, into premiums for the salespeople. And presumably this transaction actually occurred. Some people have questioned whether it happened. Presumably it happened, and presumably the salespeople ripped off their client by selling them coins when they should have said, you know, buy a few thousand ounces of coins, but let's be reasonable. Most of your $10 million should go into 1,000-ounce bars. As a result, she's a third of the way in the hole. And, you know, if she wanted to get a 10% return and she had bought bars at $22 an ounce, $21.58, she would need to see $24 to have a 10% return. But now she needs to see $36, $37 silver, which has been seen for a couple days back in 2011 and maybe one day in 1980. So she's really in the hole as an investor. Of course, she's not an investor. She's waiting for Armageddon. And at Armageddon time, she's going to need 1.5 million ounces of silver in coin form to buy bread and milk and gasoline. It just doesn't make sense. Other questions and comments? John, a couple of weeks ago or last week, said, what would you say if silver does marketeer upwards and the court says they are guilty of price manipulation? I'm not sure what marketeer upwards means, so I won't address that. But, you know, I'm assuming, and I shouldn't assume. Yeah, people keep saying, is this trial of 4 JP Morgan people for spoofing the beginning of revelations? No, this is the epilogue. Yeah, the investigations occurred several years ago. The fines against JP Morgan several years ago. The restrictions against JP Morgan occurred several years ago. This is the epilogue to the investigation and the resolution of the investigation. So you can almost assume, I won't assume because that would be inappropriate of me, one could almost, folks will be found guilty because this is the epilogue of a very long, detailed investigation that really was resolved 2 years ago, 3 years ago. So yeah, there it is. By the way, I did some work last August and I showed it out at the Silver Symposium, and I'm going to refer again to it at the Silver Symposium again, and I will point it out just very briefly here. We looked at outsized market moves in, I think, silver, because it was the Silver Symposium. And most of the outsized moves were to the upside, not to the downside. Spoofing occurs to the upside and to the downside. So when you hear that someone has been jerking the market around on an intraday basis by spoofing prices, it doesn't mean that they were trying to push the price down at any given moment. And in fact, the data suggests that most spoofing was trying to push the price up. So those of you who believe in grand conspiracies to suppress the silver price and have been disappointed because there's absolutely no evidence of such a grand conspiracy, And in fact, the banks make more money at higher silver prices than at lower prices. So they have no economic or financial motive to suppress the prices on an ongoing basis. They have every financial motive to push the prices up or allow prices to rise at their natural pace. And now you hear that some guys have been accused of spoofing the market on an intraday basis. And you're saying, the grand conspiracy. No, 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 no. Most of the spoofing actually occurs on the upside. Duh. Somebody else asked, any thoughts on what happens if rates increase to a level where the US government cannot pay the interest on its debt? Now, this is that reductio ad absurdum way of thinking. We do have thoughts, and we do think that there might be a time at some point yet this century where that could happen. But, interest rates are not going to rise so high that the US government cannot pay interest on its debt. And as interest rates rise, the credit markets start shaking if they get to really high levels. And the last interest rate to have pain is the US Treasury, at least now and for the foreseeable future. So if interest rates rise, there'll be a flood of investors seeking security in US Treasury. It's highly unlikely that you would see the Fed, whose sole customer is the US government, the US Treasury, try to drive its sole customer into bankruptcy by raising interest rates so high as to bankrupt it. Market forces could push it that way. And as I said, maybe sometime in the next 80 years, we'll see that. We do have scenarios where we put that in, but it's not going to happen in my lifetime. You will be wrong about gold and silver if the central banks have to mint a digital asset that's backed by commodities. Physical metals would disappear. Tyler, I would be wrong. But the probability of central banks issuing digital currencies backed by commodities is something less than 1%. All you have to do is listen to the governments and forget the Putin-esque propaganda and forget the crazy guy in Malaysia who 20 years ago was talking about a gold-backed Asian currency. And all of his neighbors said, yeah, you should retire. Forget those guys and listen to the central banks, monetary authorities, ministries of finance, treasuries, mainstream economists, currency economists. No one is talking about a commodities-backed digital currency, except when they play parlor games. So it's just not an issue. Doesn't mean that you shouldn't have gold and silver holdings and cash reserves, but not for that reason. Now, John also commented, I'll give it till November and the jig's up for the US dollar and the bankster crooks that run the show. John, I'm counting on you. I think you're probably a moral, honest, forthright person. And I want to hear from you in November when the jig's not up for the dollar and the bankster crooks that run the show, I don't know, you didn't really have a verb there. I guess the jig's up for them. I want to hear from you in November. And I think that because you're an honest and moral and upright and intelligent person, you're going to say, okay, I was waiting until November to see this and it didn't happen. So I'm going to go back and I'm going to start studying the markets and see what I got wrong, because I've gotten things wrong. And that leads to the CPM challenge. There are a lot of people out there who have spent their entire careers telling investors, hey, gold and silver are going to rise to unrealistic prices. The world's running out of silver. The world's financial system's going to collapse. The dollar's going to collapse. Governments are going to confiscate all your gold and silver. Put a date on it. Put a date on it. And if you're a promoter and your wildest prophecy doesn't come true, do the ethical thing and get out of the business. And if you're an investor and you've been believing this stuff and your date comes and goes and the world hasn't ended, silver is $28 an ounce, Get yourself some good research. Okay, that's our challenge. You don't need to come back to us on it. Do it for yourself. As Michael Jackson said, the change starts with the man in the mirror. Talk to yourself about it. Put a date on it. You don't have to tell us what your date is. You might want to tell your wife because she's probably pretty much fed up with you going on and on and on about how the world's going to collapse and we have to have all that silver and all those pork and beans down in cans in the basement. Say, okay, if it hasn't happened by November or Christmas time or 2023 or the election in 2024, I'm going to go back to the drawing board and say, maybe I got something wrong. Just maybe. And then you can do like that other guy did, who's been trashing me, saying, saying the world's running out of mineable silver for like 10, 12 years. And then sotto voce, he goes on some little crazy ass corner, black, dark corner of the internet and says, okay, maybe Jeff Christian's right. But it doesn't matter that we have all that silver that we can mine because we won't have the energy to mine it. Just as wrong about the energy as he has been about silver. And he's not man enough to stand up and say, okay, I've been wrong for 12 years, my entire career. And Jeff's been right. And I've been calling him all sorts of nasty names. And then I don't know why he won't talk to me. If you get some real research, buy our gold, our silver, our platinum yearbooks. They're $160 each. That's less than an ounce of gold. It's a few ounces of silver, a few more ounces this morning than it was yesterday. And they're really good. We have a retail investor program that gives you the yearbooks along with plugging you into our ongoing research and consulting commentaries, including monthly reports, silver trade recommendations, gold trade recommendations that are expanded from the ones you can get for free elsewhere. Plug yourself into real research. We will be at the Silver Symposium at the end of this month. We're really looking forward to it, and we're really looking forward to seeing you there. And we will have this evening of the evidence for and against silver market conspiracy theories. We have Matt Hunter, who's the retired head of market supervision and oversight at the CFTC. And he'll be talking and joining me on that platform. He's also giving a speech at the Silver Symposium. And we'll have Bob Coleman there, who provides precious metals and wealth management and advisory services to investors. Be there or be square, as Buddy Holly would say. I'm sorry, but I have a Buddy Holly song stuck in my head. It won't matter anymore. Anyway, you can go to our website, get some free reads, see some old videos, and we'll talk to you next week. In the meantime, if you're in the Northern Hemisphere, stay cool. If you're in the Southern Hemisphere, stay warm. I was talking to somebody on a Zoom call earlier this week, and he had this big, heavy sweater on. And I was sweating just looking at him. Take care of yourself, take care of your loved ones, take care of your neighbors. Watch out for those cats on the street. They probably need some water, those stray cats, if we're into rockabilly music. As a theme, sub-theme today, take care of everybody, and we'll talk to you next week.